Hello fellow traders, today is another of many videos where we cover things in the market. Today we cover CPI data and rate hikes and how it affects trading by Pajama Trader. What is the CPI? The CPI is the Consumer Price Index. The CPI is a statistical measure used to track changes in the average price level of basket of goods and services commonly purchased by households over time. It expresses as an index, with the base year typically set to 100 and subsequent years' values reflecting the percentage change in prices relative to the base year. CPI is a key indicator of inflation, which is a rate at which the general price level of goods and services rises, leading to the decrease in purchasing power of a currency. It helps policymakers, economists, and investors assess the extent at which inflation is affecting consumers' ability to buy goods and services. CPI is widely used to make adjustments for inflation, such as in the calculation of real wages and the adjustment of investment returns, to provide a more accurate picture of economic trends and financial decisions. What role does inflation have? Inflation is the rate at which the given price or level of goods and services rises over time. It plays a critical role in the economy as a measure of economic health and stability. Why is it important to control inflation? Stable, moderate inflation is generally considered healthy for an economy. High or hyperinflation can lead to detrimental effects, including eroding the value of money, creating uncertainty, and distorting economic decisions. Inflation affects its purchasing power. As prices rise due to inflation, the purchasing power of a currency decreases. This means that the same amount of money can buy fewer goods and services. It can negatively impact consumers' ability to afford necessities, leading to decreased living standards. How inflation affects investments. Inflation erodes the real return on investments. For example, investments that yield a 5% return, but inflation is 3%, the real return is only 2%. Investors often seek investments that outpace inflation to preserve and grow their wealth. Fixed income investments like bonds can lose value in real terms when inflation rises, making them less attractive. Overall, managing inflation is crucial for a stable and healthy economy, as it affects the purchasing power of many consumers, the profitability of a business, and performances of investments. Central banks and policymakers closely monitor inflation to strike a balance between growth and price stability. Rate hikes explained. Rate hikes, also known as interest rate hikes, refer to actions taken by central banks to raise the benchmark interest rates in an economy. How central banks use rate hikes to combat inflation is: central banks such as the Federal Reserve in the United States increase interest rates when they aim to control or curb inflation. By raising interest rates, central banks make borrowing more expensive, which can reduce consumer spending and business investments. Higher interest rates can lead to increased savings, since the return on savings accounts and bonds are more attractive. These measures collectively help reduce demand in the economy, which can lead to slower economic growth and lower inflation. Central banks use interest rate hikes as a preemptive measure to keep inflation in check and maintain price stability within a target range. CPI reports in stock markets. CPI reports can have a significant influence on stock markets due to their role as key indicators of inflation. How CPI reports can move markets. Inflation expectations. CPI reports provides insights into the direction of inflation. Higher than expected CPI figures can raise concerns about rising inflation which may lead to market uncertainty. Interest rate speculation. CPI reports can impact expectations regarding central bank actions. High CPI numbers might prompt speculations about the future interest rate hikes to control inflation, which may affect the stock market sentiment. Corporate earnings. Inflation can affect the cost structure of businesses. Higher input costs due to inflation can affect and impact corporate profitability, potentially leading to stock price adjustments. Examples of significant price movements or market movements due to CPI reports. When a CPI report suggests unexpected high inflation, stock markets may react negatively, with declining stock prices, especially in sectors sensitive to raising prices or raising costs. Example, consumer discretionary. Conversely, lower than expected CPI figures may lead to positive market reactions, as they indicate lower inflationary pressures and potential for continued economic growth. Major market indices like the S&P 500 and the Dow Jones Industrial Average may experience fluctuations on CPI report release days, depending on the report's implications for interest rates and inflation expectations. Trading strategies for rate hikes. 1. Anticipating rate hikes. Monitoring communications and economic data releases to anticipate rate hikes. Pay attention to forward guidance from central banks, such as statements about future rate actions. 2. Interest rate sensitive assets. Consider reducing your exposure to interest rate sensitive assets like longer term bonds and dividend yield focused stocks when rate hikes are anticipated. 3. Rotation strategies. Implement rotation strategies by reallocating investments into sectors that tend to perform well during periods of rising interest rates, such as financials and cyclicals. Short-term fixed income. Number 4. Allocate funds to short-term fixed income or cash equivalents to minimize interest rate risk in your portfolio. 5. Risk management. Diversify your portfolio across different asset classes to reduce overall risk. Use options or derivatives to hedge against potential losses in specific investments or market segments. 6. Actively monitoring. Continuously monitor the economic landscapes and central bank decisions for changes in rate hike expectations. 7. Volatility considerations. Be prepared for increased market volatility around rate hike announcements and adjust your trading strategy accordingly. Number 8. Gradual position adjustments. Instead of making your abrupt changes, consider gradual adjustments to your portfolio to reduce the impact of market fluctuations. 9. Technical analysis. Use technical analysis tools to identify potential entry and exit points in the market based on price trends and momentum indicators. Fundamental analysis. Number 10. Incorporate fundamental analysis to assess the financial health and growth prospects of individual companies or sectors. 11. Risk-reward assessment. Assess the risk-reward profile of your trades and investments, ensuring potential gains outweigh potential losses. Stop-loss orders. Implementing stop-loss orders to limit losses if trades move against your expectations. Remember, trading strategies should be tailored to your risk tolerance, investment horizon, and financial goals. It's essential to stay informed, adapt to changing market conditions, and consider seeking advice from financial professionals when necessary to make informed decisions. The importance of staying ahead, informed, and prepared. Timely and informed decision making is crucial when trading around CPI reports due to their potential to influence market sentiment. Being prepared for market reactions and having a plan can help traders navigate the volatility associated with CPI releases. Remember, CPI reports will impact various asset classes, including stocks, bonds, currencies, and commodities. It's essential to assess your risk tolerance and adapt your trading strategies to match your goals and the specific market conditions surrounding CPI releases. Case study. Preparation before the CPI release. The Pajama Trader conducts research and anticipates a possible market reaction to the CPI data release. The CPI report release day, September 21. The CPI report for August 2021 is released, indicating higher than expected inflation. Initial stock trade execution. The trader purchases 100 shares of the SPY at its market price of approximately $444 per share. The initial options trade to go along with the stock trade. Simultaneously, with the stock purchase, the trader purchases SPY call options with the strike price of $450 and the expiration of December 2021. The price of the SPY call options with the $450 strike is approximately $10 per contract. Monitoring and managing. The trader closely monitors the market's reaction to the CPI report and central bank actions related to the rate hikes. The trader sets a stop loss order on both stock and options positions to limit potential losses. The trader's outlook changes due to the economic developments or central bank's guidance that suggest a more aggressive approach to rate hikes and negatively impacts the options value or the stock's position. The trader considers exiting both the stock and options positions. The Pajama Trader manages the risk by setting stop loss levels on the stock and options positions. Additionally, the Pajama Trader ensures that the total investment aligns with their risk tolerance and financial goals. Please note that this is a combined strategy that involves both stock ownership and options trading, each within its own set of risk and potential rewards. Options trading, in particular, requires a good understanding of options mechanics and market dynamics. Real-time pricing and market conditions should be considered when executing such trades. To recap, here are takeaways from today's presentation. We've explored essential concepts like CPI reports, rate hikes, and their impact on stock markets. Now, to stay informed and make strategic trading decisions, it's crucial to remember these key points. But that's not all. If you found this information valuable and want to continue learning about finance, trading, and investment strategies, please consider giving us a like and sharing this presentation with your fellow traders and investors, and subscribing to our channel for more videos like this. Your support helps us to bring more insightful content in the future. Thank you for joining us, and we look forward to the next video. Thanks for watching.